I'm Parker Elmore from Odyssey Advisors. I have Kathleen Glowacki here from Bartholomew Company. They're an investment firm located in Worcester, Massachusetts, and they do work quite a bit in the municipal sector, and I'll let her give her whole spiel when the time is right. But yeah, I mean, basically the idea behind this is we want to talk about alternative investments, because I know we work with, hundreds and, many hundreds of municipal type clients, and, a lot of you guys have pension plans and OPEB plans. And the question is always like, where should I be investing? To which my answer is always going, not my job to tell you that, but I can give you some certain suggestions about asset allocation in terms of how GASB will create your discount rate gets used to value both your pension plan and your OPEB plan. And that's based on how you allocate your assets. And one of the places in which you can allocate them is in something called alternative investments. And I'll let Kathleen describe exactly what those are. But basically the gist of it is, and many of you guys have heard me talk before about the GASB methodology, if you follow it to its logical conclusion, would have you invest in the most riskiest, bizarre things to get the highest discount rate, which obviously makes zero sense. But if the idea is just, I want the highest possible discount rate and show the lowest possible liability, you're in penny stocks and Zimbabwe equity futures and you name it, weird, ridiculous stuff. But over the long term, it could theoretically make the most money, but it's going to be incredibly volatile. So how do we increase the discount rate and perhaps even reduce volatility at the same time? So what you guys, I'm going to share a screen here and show you a little bit on discount rates and how they do, and I'll hand it off to Kathleen because I know you're really all here for her. So let's pull this thing up here, and if this goes as it should, we have, come on screen, you can do it. And all right, so alternative investments and how do they impact discount rates and liabilities? Now, this is for your pension plan or your OPEB plan. Give you the 5-second thing on our firm. We've been around since '98. We're actuaries, we're management consultants. We do this stuff for 500 plus municipalities. We're in Connecticut, Nevada. I'm in Wyoming today. I'll be in Idaho tomorrow. We're in 37 states, so I spend a lot of time on planes. Enough of that. Anyway, so GASB 67 and 68 and GASB 74 and 75. The discount rate is a blend of either the 20-year municipal bond index or the long-term rate of return. So the municipal bond index, many of you guys have seen, has gone up quite a bit in the last year and a half. But the discount rates are really a mix of those two. So if your plan is very well funded, you're going to get the long-term rate of return, which is basically calculated based on however you allocate your assets. And we'll show a couple examples of that. If you're not funding at all, you're very poorly funded, municipal bond index is going to be what's used for your discount rate. Now, a couple of years ago, you guys were all using discount rates of 2, 2.25. Now you're using interest rates of 4, 4.25. And so you go, look at me, my liability dropped by 30, 40%. I'm so smart. I caution you to go, you had nothing to do with it. The Federal Reserve decided to increase interest rates, and all of a sudden your liabilities go way down. And guess what? When the Federal Reserve decides to lower interest rates, your liabilities are going to go right back up again, which is why we always encourage people to fund to the extent you can. If you're in that in-between stage, we'll have a blended discount rate that says, here are certain payments made at the long-term rate. Here are certain payments at the municipal bond rate. What is a single interest rate that would get me to that same overall liability? So again, as we talked about, the well-funded plans, the long-term rate of return is going to be the thing. For most pension plans that have been around for a long time, they actually have actual assets in them. So they are largely funded at the long-term rate of return and measured for accounting purposes at the long-term rate of return. For your OPEB plans, in order to get that long-term rate of return, you generally, there's a math behind it, but I'm not going to bore you with all that. But basically, you need to have about 2 times your annual projected benefit payments in terms of current assets, and also have a commitment to keep funding over time. So if you go, hey, I have a pot of money and I'm never going to put another dollar in, well, then yeah, that money's going to get exhausted and you're not going to be able to use the long-term rate of return. But if indeed you are funding and will be continuing to fund, then yeah, you will be able to use that long-term rate of return. But for most OPEB plans, they are not well funded or barely funded at all. I know many of you guys have seen our funded status report, and about to get into the 85th percentile for OPEB plans, you got to be about 20% funded, which is embarrassingly low. But the reality is there's only so many dollars to go around, and you're funding a pension plan, and you don't have more money to fund OPEB, and we certainly understand that, but that's kind of where we stand. As we spoke about, if you have minimal or no assets, you're going to use the municipal bond index rate. That's a 20-year rate. We use one from Standard & Poor's. There's other ones out there from Bond Buyer. There's another one out there from Fidelity. They're all basically the same rate, plus or minus a tenth of a percent. So they don't really move that much. But as you've seen what the Federal Reserve has done, if you're issuing debt, it's been painful because it's a lot more expensive to issue debt now. On the other hand, your OPEB valuation, your liabilities went way down. But those of you who've heard me speak before, I'll always tell you, I would much rather have lower interest rates and show a higher OPEB liability, because borrowing money has real cash costs. You're actually spending money to pay off that debt. Whereas when your OPEB liabilities are a balance sheet item, so I don't lose a whole lot of sleep over that. And let's see one thing here. Sorry about that. So we'll look at one quick thing here. Sorry for the pause. Just gotta. Okay, that's not a concern. All right. Sorry about that. I was just had a ton of messages coming in here, and I thought it had something to do with this, but apparently not. So my apologies. So again, under GASB, to create this long-term rate of return, it's all well and good, and you guys have all seen it go, well, the market earns about 8% a year, and that's lovely. But as I pointed out, there's a stat I saw recently and said in the last 95 years, the market has earned between 8 and 10% once. So that doesn't really happen. So everyone tells you it earns 8 to 10% a year. Now, if you compound that over time, there's been many times that it earns -5 or +25, but it doesn't generally earn between 8 and 10% a year. That's just where people come down. So it's an interesting exercise. And so under the GASB model, what we're forced to do is to look at all assets by asset class and what the projected real rates of return are. That means before any inflation. And then we have to take all those together based on whatever your asset allocation is and develop a overall long-term real rate of return, and then add the inflation back to get the nominal rate of return. Now, here's the thing. Those real rates of return, those are forecast to be the next 20 to 30 years. They're not looking backwards. So you can say, well, gee, over the last 20 years, large cap growth has earned X. That's great, but this is really what is it going to do over the next 20 to 30 years, to which I can guarantee you none of us know. So, what we do is we use a survey model to look at about 35 different investment advisors. They all come together and give their forecasts. And then, as I always joke, it's kind of like Olympic score, and we throw out the high and the low and use what's in between. I can guarantee you their forecasts are also wrong, but that's the nature of forecasts. So you're making our best forecast at the time. They get adjusted every year, and that's kind of how we do it. And, Kathleen and her firm have their forecasts. Other investment firms have their forecasts. No one's willing to say, I will guarantee you these rates of return. These are all what we estimate things to be. So here is from the forecast that we use, and this is an actual real legitimate client who just delivered their valuation in the last couple of weeks. And they have, they're putting 20% in domestic equity, large cap, and 35% change in mid cap, and developed markets, emerging markets, fixed income. They don't have any alternatives. And this municipality is doing their own thing. They're not with one of the investment firms you guys have ever heard of before, but they're doing their own thing, and good for them. And you take our forecasted long-term real rates of return before inflation. So domestic large cap is at 4.1, mid cap 4.5. Developed markets and international make a little more, emerging markets and so on. But alternatives are a 5.95 real rate of return. So basically, 1.5% to 2% higher than you're going to get on domestic equity over the long term. Again, no guarantees, but that is certainly the forecast. And then we take all that, we come up with a 3.46 overall real rate of return. We had 2.5% for inflation. Again, this is meant to be a long-term forecast of inflation. You're going to tell me, well, we had 8% inflation last year, to which I'm going to say, yes, we did. Also not terribly relevant, as it's a long-term assumption. Now, the Federal Reserve is trying to get to 2%. I would like to get to 2%, but I'm a little suspect of the Federal Reserve right now being able to get to that number. So that's why we're at 2.5. If and when we see evidence they're really going to be able to exert the political will to get to 2, then we'll certainly adjust that. We have an investment expense here of 1/4 point, so we did 571. But now let's say we're going to take out 10% of this domestic equity and we're going to move it to alternative investments. So now we see 10 here and 10 here. But now we've gone from 571 to 590 because we get the use of this 5.95%. And to show you what that really does, this is that same client I was speaking about. In all of your reports, whether it's with us or somebody else, you'll see a plus and minus 1% on the discount rate. So they're at 571. If their discount rate went up by a full point, the liability would drop by almost $3 million. So you figure you're going up by 20 basis points, you're going to go up by, they're going to get about $600,000 savings on their liability, or about 3%, simply by moving 10% of their assets from large cap equity to alternative investments. And again, whether if you're with us, you've seen this chart before, but even if you're with another firm, this chart should be in your pension report. This chart should be in your actuarial OPEB report. So certainly go look at that and see, what kind of a potential possibility you have with using alternatives in your portfolio. So, I mean, again, this is I never want to say it's a simple way to lower your liability, because you shouldn't be investing with this sole purpose of saying, I want to game the system here and increase my discount rate and lower my liability. The idea behind moving from one asset class to another has a lot of things that go into it in terms of your risk tolerance, your tolerance for volatility, what your taxpayers will support or not support, what laws may be in your community in terms of what you're allowed to invest in. So there's a lot of things that go into it, not just trying to chase, the yield. Because again, if you went back here, you'd say, well, let's put the entire portfolio in real estate. Well, you could, except for the fact real estate's not liquid, and you're probably going to need to make benefit payments, and you don't have any cash to make benefit payments. So real estate might be great, but you still need liquidity to make, pension payments or OPEB benefit payments. So that's really all I've got. I'm going to stop my sharing here. So that's really what I've got. One thing I should have mentioned at the beginning, if you open up the chat window in your webinar, on the bottom right, you're going to see a thing that says hopefully it says 2 hosts and panelists. But you can change that to be everyone is what I would recommend. And that way, any questions you have, certainly you can put them in the chat. You can also put them in the Q&A. We're certainly happy to answer questions there. I'm going to put the copies of both presentations in the chat. So if anybody wants to download it, you'll be able to do that. But with that, I'm going to hand it over to Kathleen. So Kathleen is basically the retirement guru over at Bartholomew. Many of you already work with her, but many of you don't. She does a lot of this kind of stuff. To the best of my knowledge, she does not have a direct line with Jerome Powell, the Federal Reserve, but nonetheless, she certainly follows what they do. And, I don't know that Warren Buffett is calling her for advice, but, certainly they had a lot of the same kind of things that they're doing. They're going through all this stuff. They're following what the Fed does, what Congress does, what the market's doing, and they're trying to come up with the ways to, make this stuff all make sense. So I'll let her talk about, again, what are alternative investments? What can they possibly be used for, and how they might be useful to you guys?
Great. Thanks, Parker. And thank you, everyone, for joining us. This is a really exciting topic. I think it's just a fascinating space because it is so complicated and strange. And so we'll get into some of that. So I'm really excited to get to talk to you all about this. So just quickly about us, if you don't know Bartholomew and Company, we're a privately held investment advisory firm. We're located in Worcester, Massachusetts. We've been around for almost 30 years now. We have a 14-member institutional team working with our government and institutional clients. And so you can kind of see a breakdown of the types of assets we help our clients invest. But really, kind of jumping straight into this, what is, first of all, an alternative investment? And so the best way to describe it, and it's probably the least helpful way to describe this, is that it is a non-traditional investment. And so the investment itself can be non-traditional, or the vehicle itself can be non-traditional. So what does that mean? It basically means an alternative is not a stock, bond, or cash. So really, it's easier to say what it's not rather than what it is. So the investment can be anything outside of kind of those three categories. And then you can have the vehicle. And I think this is an important caveat, because you can have an alternative investment that, let's say, has stocks in it, but they might be shorting those stocks. So essentially betting that those stocks will go down. And that, based on the vehicle, based on the hedging and derivatives that they use, that would also be considered an alternative investment. So we'll get into some more examples, but that's your most generic, high level, what is an alternative? And so what are some of the characteristics of non-traditional investment? And so not all of these that I've listed here have to occur at the same time. It's just that these are some of the more frequent, or there's one that applies, maybe they all apply. But the big thing is that there's less correlation to traditional markets. So that makes sense. It's something outside of the stocks and bonds and cash. And so these are investments that behave differently than traditional markets. That's really the kind of the key takeaway and why we invest in them. And I'll talk a little bit more about that. There can be less transparency into these types of investments. So if you think about a company like Amazon, it's a publicly traded company. I can read about their financials. I can read about their earnings. I can track pretty much everything that they've got going on financially. So it's a very, very transparent type of company. When you're talking about some of these other types of investments, the access to information might be a little bit harder to rely on or to even get, quite frankly. There can be higher fees for some of these. If it's in a pooled fund, there could be performance fees, management fees, less regulation. So the SEC has just kind of, again, these are general, but less regulation around some of these. And some of that ties into the next point, the investor type restrictions. So sometimes these types of investments can only be invested in if you're accredited or if you're institutional, which is why, I think this applies very much to this group, is that you can, with asset sizes of these large communities and foundations, you can access some of these things that maybe the general public might not be able to. And then one of the other caveats is redemption restrictions. And that's a very important point in regards to what you can buy and if you have to commit to owning some of these for a long period of time. So those are some general characteristics. But two things I wanted to point out before we go into what some examples are. I think this, for OPEBs and really just for general knowledge, these are two very important things because they are very unique to alternative investments. How do you access them, and understanding liquidity? And Parker touched on this, and that's a key point. But first, in terms of access, just at a general level here, direct investing. So if I bought a piece of real estate, that's me directly investing into the real estate. I'm buying it with cash, let's say. So there's no fees. I'm not hiring someone to kind of manage this. I'm doing it. I have all the control. You can do that with a lot of different types of investing. You can buy gold bars, for example, silver coins, things like that, directly investing. Some of the cons are you have to kind of know what you're doing there. That's not something generally for an everyday person or even anyone in our space. We're not really trying to do these one-off trades directly investing. There's a lot of concentration risk. You need high asset volume for that. Co-investing, where you're kind of partnering with a different firm, you're sharing knowledge, you're sharing capital. Some of the cons there: reduced control, a little bit of higher fees. And then finally, what I think is probably most applicable would be pooled funds. And so this is where you can access managers with expertise and diversification in any of these spaces that we're going to talk about. But the cons, of course, and this will keep coming up, is on the fee side, on the cost side. And there are some other ways to access some alternative investments, but it's just from a broad level, I think it's important to know, how do people even get access to these things? And so pooled funds of some kind may make the most sense in these terms. And then liquidity. This is a very, very important and I think less understood caveat when we think about suitability of these types of investments. So you have liquid assets, right? And it's anything that can be quickly convertible to cash. You can buy and sell throughout the day. There's an established market. So if you think about stocks, like I just said, Amazon, that's considered liquid. I can buy that right now, and in 5 minutes I can sell it. There's lots of buyers and sellers. Treasuries, bonds, for example, another very liquid asset. There's a lot of activity around those. That's the type of money, for example, if you think about stabilization funds or something that needs to be easily accessed should there be something that comes up and you need that cash on hand. That's most appropriate for liquid assets. And then you have semi-liquid. So these can be pooled funds, for example, that have monthly or quarterly liquidity. You might see the term evergreen, and evergreen in the alternative space just means that on a periodic basis, you can invest in some of these funds. So sometimes you'll have, on the illiquid side, you can buy it at a certain point and you're stuck in it for 10 years. And there are pros and cons to that. The semi-liquid space is you kind of have these certain times you can get in or get out. So that can be a little more appropriate for an intermediate or long-term type of fund. And then illiquid. So this is not quickly convertible to cash. There's risk and reward here. When you give up liquidity, the expectation is that you'll get higher return, but it can be risky. There's low trading activity. You can get kind of stuck there and the market can be less established. So I think my point with this, especially on the liquidity side, when you think about the type of account we're talking about, it's very easy to say we want all liquid investments because it's safer. And that is true, but for something like OPEB, where it is long-term, where, as Parker said, there's still a lot of funding that needs to happen, you can give up some liquidity. You have some time, potentially. Again, this is not a sweeping statement, but it's something that you could definitely think about or talk to your advisor about, because there may be some opportunity to kind of step into some of that semi-liquid and illiquid-ish space. So what are some types? These are all very generic, but a couple of things I just want to touch on here. So hedge funds, this is probably the most generic term in the alternative space. And all it is private management of securities or derivatives or hedging, things like that. So kind of my morbid way of saying this is you basically find someone you think is really, really smart, and you give them $1 million and tell them that they can kind of do whatever they want with it. And you may or may not know what it is that they're doing. And I don't mean that in a negative way. It means that there are some really, really good hedge fund managers out there who have an insight into that very non-transparent space. And normally they have higher lockups. So you're kind of in these funds for a long time with higher minimum contributions. So they're expecting, of course, larger asset sizes. Private equity. So private equity is frustratingly, in my position, a very, very generic term. Private equity can mean venture capital. It can mean you're investing in a startup that's highly innovative, that's, it could really work out really, really well, or it could really, really crash and burn. It could be very, very risky, or private equity could be a very mature company that has just been around for a very long time and for whatever reason isn't public, or maybe was public and then became private. So private equity runs the gamut. And I think this is one that we talk a lot about with OPEB. So I think one of the key questions for clients should be or could be, what kind of private equity is this? It doesn't have to get into the nitty gritty. It's just, am I investing in venture capital, which is great and exciting and could be very appropriate, or is it a little more mature? Can I expect, what kinds of returns can I expect from these types of things? So a private company doesn't mean it's a less legitimate company than public. It just means there's kind of a wide variety of things you could see here. Private debt, same thing. It's debt for those types of companies. Same kinds of questions apply. Another alternative is natural resources and commodities. So oil, gas, gold. You know, if you think about in 2022, equities and bonds did really poorly. And so if you think about gold, for example, that was a very steady investment. And that comes back to my point of less correlation. So something as kind of boring or exciting as gold, I guess, depending on what how you're receiving it, it behaves very, very differently from traditional markets. So that's an example of that there. And then real estate. Again, real estate can run the gamut. It could be single family homes, or it could be a casino. You really have a wide variety, public or private, generally, of course, income generating. And those can come in pooled products as well, or it can be a very direct investment. So again, I'm kind of broad stroking here, but there's a lot of options, especially with real estate and private equity. Infrastructure, I'm sure everyone's familiar. This, of course, would be roads and airports and things, investing in things like that. And other tangible assets. One of the strange things I was talking to one of my colleagues about is we've seen so many funds that are art funds. So they're just investing in a pool of different kinds of art, which is interesting. And I could see the appeal, and I could also see that that seems a little bit bizarre. So things like that. Wine, you know, is another, could be another tangible asset. Coins, cars, things like that. And then intangible on the flip side, patents, intellectual property, things like that. So if looking at all of this, if you think about risks, think about how you price or value these things. It's really, really, really hard. Art, I mean, is a great example of that. How there's no underlying valuation metrics on art. It's art. And so same thing with, you know, gold is tied to the US dollar. And some of these private companies, if they're a startup, they're really innovative. If they're doing something no one's ever done before, how do you value that? How do you say this is worth this amount? It's really hard. And so it's something to keep in mind when you think about risk and think about how much of this you want to own. It's a great opportunity, but it can be, you know, it can be less transparent, really, quite frankly. So why do we use them?
Kathleen, real quick, this is Parker. Just I was to launch a poll real quick about what people, if they actually have alternative investments, and if not, so you can go and let people chime in here about what alternative investments they have, if any. So hopefully everyone can see that, and feel free to join along.
Yes, thank you. Great. So yeah, so why do we use them? So the first thing I've said over and over again, and this is because it's a key point, is low correlation to other asset classes. So if you work with my team, I apologize because you've heard this probably 1,000 times, is that alternatives smooth out the ride. That's our kind of what we say over and over and over again. One of my other colleagues says that alternatives zig when the market zags. Very simple terms, but all it is really, it's just behaving differently. And so when you have the really, really high markets, your alternatives might drag your performance down a little bit. because they behave differently. They're going in a different direction. But if the market's kind of crashing, let's say, hopefully your alternatives can sort of ballast some of that. So that's a great reason to use them, of course. Number two is an obvious one that I didn't even touch on, was return. And Parker kind of talked about this, which is a very important point. If you're going to take on some of these risks, you expect higher return. And in a lot of cases, that's obviously possible. But number three is, to me, the most fascinating, and it's that times are changing in always, but especially over the past couple of years. For example, on this chart that I have here on the bottom, this is coming from a private equity firm. They tracked publicly traded companies versus private equity backed. And so this is just one example, but what you're seeing on that light blue line that's on the top and then goes down to the bottom, that's your publicly traded company. So less companies are publicly traded, less companies are easily accessible, and more are private equity backed, for example. And so if you think about wanting to invest in the economy, owning stocks, bonds, and cash doesn't really represent everything, especially if you look back at that list of what I showed you. You know, alternatives don't mean unusual, and they don't mean they're not frequently used. It's a big part of the investable universe and becoming really quite bigger in a lot of ways, for example, on the private equity side. And then in terms of OPEB, this comes up a lot is, you know, is this appropriate for OPEB? And of course, that depends on the situation. But if you think about pension funds as well, and a lot of these big pension funds, for example, the California State Teachers Retirement System, I think I got that name right, it's hundreds of billions of dollars. And they are a pension, and they just this month reduced their equity exposure by 4% and reallocated that into alternatives. And I'm by no means saying that we should just copy what this hundreds of billions of dollars fund is doing, but the point is that these pension funds are kind of indicating that based on market environments and based on long-term returns and based on what they have to pay out, a better opportunity could be or a diversifying opportunity could be more in alternatives. And so if you want to, for OPEB, really hold it to the same quality and same, just same overall view as pensions, because it is like that type of money, it makes sense to have alternatives in a lot of cases. So then, oh, there we go. So coming back to this point of risk, this is what I find very interesting. Some of these things I touched on, I'm not trying to scare anyone away from alternatives, because some of these risks actually have benefits. So when you think about liquidity, you know, oh, I'm going to be locked into something for a little while. Maybe that could be scary, and it comes up a lot with clients. It's a little intimidating, but it means that in some cases, you might not suffer the panic selling. So if you think about the stock market, let's say a couple of stocks, maybe big ones, one day are down for some reason, they missed earnings. So, you know, those stocks are down a lot, and then people start to get nervous. So they're selling their other stocks, and then other people get nervous, and it becomes a self-perpetuating downfall. Was it warranted? Sometimes, sometimes not. And so when you are kind of locked into something, even with a semi-liquid product, you're insulated from that. You can't easily panic, and you can't easily be emotional about some of these things. So you can avoid those kind of panic, emotional, psychological market trends. So again, it's not saying that the liquidity issue is a non-issue. It's just there can be benefits to things like this. Less transparent. So it seems like a bad thing for us on the investment side, but a lot of times these public companies, if they miss earnings, whatever, and people don't even tend to really know what that means sometimes, or why they missed earnings. Maybe they're trying to shift their business to do something else. Maybe there's something going on in the background that's actually a good thing. They're taking on more debt, let's say, and people say debt is a bad thing generally. Maybe they're doing that for some reason we don't know, but they're subject to all of these headline risks. And so that, of course, affects, the stock market and valuations. And so when you can kind of keep some of that on aside, you can have a little bit less transparency. That can be a good thing in terms of kind of not having your heart on your sleeve as a company at all times. And then less efficient, meaning, again, kind of to the same point of less information out there. So less access to broad information about something like Amazon or McDonald's or something like that. And what that means is you could have less expertise out there. So more of an opportunity for arbitrage, more opportunity for higher return or something to really find something very exciting. So all that, not to say that these are not risky, that we should go 100% private equity or anything on that list. You still have to keep things in mind. Liquidity needs, what is really appropriate for this type of money. We would never, on our retail side, we typically, shouldn't say never, but typically if we have an 80-year-old client, we're not buying something that is highly illiquid. It's not appropriate. So what on the community side, what are the liquidity needs, cash flow needs before you invest in something like any of these? And then fees, of course, that's another real big question to always ask, and reliability of data and transparency. So even though I'm saying, less transparent could be a good thing, it's still important to understand what you own. And so finally, if you're not convinced, I guess, to at least think about some of these things or talk to your investment professionals about this, or do your own research, I just wanted to, again, on the same note of risk, we talked about non-traditional investments, our traditional investments riskless. And so stocks, I think we can pretty obviously say no. With stock market volatility, there's risk there. So you can't forget that. If you're trading out some of your equity for some private equity, you're not going from riskless to risk. There's risk in both, right? What about bonds? Well, if you invested with bonds in 2022, you know that there can be a lot of risk there. Interest rate risk, when interest rates rise, the value of your bonds goes down. There's credit risk. If you're investing in a corporate bond, you are expecting that corporation doesn't default. So there are risks even in bonds, which are considered, a pretty safe investment. And then cash, the safest investment, hiding something under your mattress, right? Well, what about inflation? That's a real risk too, that you've lost your purchasing power. So kind of all of this, finally, my real kind of last final point about all of this is that, not the disclosures yet, is the diversification of risk. So when we're out talking about alternatives, we're really talking about diversifying your allocation and diversifying your risk. That's just such an important part of building a good, balanced portfolio. Understanding what you own, asking some questions. Hopefully this helps give a couple of questions you could ask if your investment advisor is talking about some of these things. Understanding what you own or what they're kind of recommending, at least broadly, is pretty important, because again, these are very complex products. Doesn't mean you should shy away from them necessarily, but there are definitely some caveats you need to be aware of. And finally, the most important, definitely to my team, is asset allocation matters. You can't bake a cake with 100% sugar, right? That's just a pile of sugar. So you can't own 100% private equity, or 100% gold. You can, but it's not a portfolio. So we've had some clients sometimes where they really like the idea of real estate and they want to go fully real estate. Well, there are times where that's not going to work out. And so asset allocation always matters. Diversifying your risk always matters. So with that, that's all I've got. Hopefully that was just a good intro, and I'm always happy to go deeper anytime on any of that.
Well, thank you, Kathleen. I mean, I just shared the results of that poll, and as you can see, about a third of the folks are in real estate, a third of the folks are in private equity. More than half of folks don't know if they have either of them or any of them. There's some gold and some commodities. So, it seems like, some people are doing stuff and a lot of people don't really understand if they have any of it or don't have any of it, which is, definitely the kind of thing you want to talk to your investment advisor about, make sure you understand what you have. And, as Kathleen talked about, some of the risk reward things, if those of you who, article in either Wall Street Journal yesterday or today talk about real estate and this syndicator of real estate. It all sounds so great. You see these things, invest in my private pool of real estate and guaranteed money. We're doing apartments and you can't lose money. And except for that, you can lose money. And a lot of people are losing a lot of money because, as Kathleen pointed out, you're accredited investors and there's low transparency. And, it's why it's important to A, deal with reputable people, and B, again, understand what you're investing in. So I think that's really, really kind of important. And, certainly if anybody has questions, you can put them in the chat or the Q&A. I haven't really seen a whole lot come through. I do see somebody with a raised hand, it looks like. Susan Kelly has a question. I'll just allow you to talk, Susan. Susan, you had a question? Or perhaps maybe your hand was up inadvertently because you're still on mute. Well, I'll tell you what, Susan, I can ask you to unmute.
I'll take it as a high five. I think
that's right. We'll come back to Susan. If you change your mind, certainly let us know. But we'll all right. So anyway, enough of so anyway, again, thank you for everyone. As a heads up, we're doing a webinar next month with Liz Farmer, who does a lot in the municipal finance space. She's a national reporter, done Bloomberg and a few other things. So we have her coming on next month to talk about the end of pandemic funding and how that's going to mean to blow up everyone's budgets and how everyone's going to survive. And we also are working with Renee Davis over at Powers and Sullivan, an accounting firm, to talk about how to read a financial statement, a municipal financial statement, and what to look for. So where do you find those hidden gems or problems, as the case may be? So we're going to try and identify, where do you find the buried bodies in a financial statement? And then we have another one on asset allocation, kind of as Kathleen mentioned. Just because you really love stocks, bonds, whatever it is, doesn't mean 100% of your portfolio should be there. I mean, yes, that is the way you become rich. That's also the way you become poor. So when you hear the people say, if you put $1,000 into Berkshire Hathaway or Apple or whatever 20, 30, 40 years ago, you'd be so much money. But hopefully the reality is you would have sold some of the money rather than just let it ride. Because, sometimes it goes the other direction. And then you go, I went from being a multimillionaire to being broke. So hopefully it takes some money off the table and do some of that. So again, I very much appreciate everyone. I know everyone's time is busy, so we're gonna let you guys get out of here. And certainly reach out to me. We put the presentations in the chat. We'll also make them available in an email that'll go out to everybody saying thank you for attending, along with a copy of the recording. So again, we very much appreciate it. And if anyone needs anything, certainly reach out to myself, Kathleen, and we will do whatever we can to get you what you need. Thank you again, everyone.
Thanks so much.
Bye, folks.